The 6 passive income streams that I evaluate in this video have helped us achieve financial independence, retire early, and travel around the world. I'm confident it can do the same for you. Hi, welcome to our channel. In this video, I'm going to evaluate 6 different passive income streams based on our own personal experiences, good experiences and bad experiences, so that it can help you make some smart choices when you're deploying your capital towards investments. I'm also going to give you an evaluation criteria and use that for these income streams, and this evaluation criteria can be very useful for evaluating any other streams of income or investment that you may choose to do in future. But before we do that, it's important to understand the difference between active income and passive income. Active income is when you use your talent, your time, your effort to make money. Passive income, on the other hand, is when you use your money to make money. And as you can obviously see, when you use your money to make money, it frees up your time, your talent, and effort. So it provides you the flexibility to either use that towards generating active income, or like us, following our hobbies, passions, and traveling. So as you can imagine, passive income is a very critical part of financial independence. So let's get started. First, with the evaluation criteria. So we're going to evaluate these 6 passive income streams on 5 evaluation criteria. And for each of these criteria, we're going to give them a score where 1 means poor score and 5 being excellent score. So that this 5 by 5 matrix of 5 evaluation criteria and 5 ratings can help not just evaluate these 6 streams, but potentially any other investments that you want to do in future. So what are these evaluation criteria? The first, the obvious one, being the returns on the investment. So the passive income that you can generate from your investment of capital that you deploy for any investment. So 1 or poor is when there is no passive income or no returns. Hopefully, we are not going to have any of these investments with that category. 5 being or excellent when there is double-digit investment and investments that beat the market, and market meaning, or the benchmark median being, that if you would have put that money in a 1-year fixed deposit in a bank, so that becomes like a median or a benchmark for the returns. The second category is capital, because in certain investments, not only you want to generate returns, but you also want your capital to grow. So if there is no capital growth, then we give it as a score of 1. An excellent score of 5 is when there is multiples of factors of capital growth. So your capital grows by 3x, 4x, 5x. And a median score would be when your capital meets the inflation of the year, because that means your capital is growing along with the inflation of that particular year. The third category is the accessibility of funds, because if you're generating money, your capital is growing, you may also want some level of accessibility of funds in case of emergency, or if you want to rebalance, or if there is any need for withdrawing that money. So poor score would be that there is a long-term lock-in of 5 years or more, and an excellent score being that there is no lock-in and the funds are readily available whenever you want to cash out, and it's very easy to cash out. The fourth evaluation criteria would be the risk associated, where a poor rating would be when there is a significant risk on not just your capital, but also on your returns. And an excellent score would be when there is no risk on the investment, both on capital as well as the returns. And the last evaluation criteria is personal involvement. How much time would you need to dedicate for generating that particular income? Poor score would be that it's really like an active income, that it involves a lot of effort, so it becomes like a 9-to-5 job. And an excellent score is that there is no involvement from you whatsoever, so it's really money is making money for you. So this 5 by 5 matrix, we're going to use that for evaluating these passive income streams that I talk about, or based on our experiences. But you can also use that, as I said, for any other investments that you do in future. So let's get started. So the first one we're going to evaluate is peer-to-peer lending. So this is when you give your money as a loan to your family, friends, colleague, or using some P2P platform. Now, when it comes to returns, in most of the scenarios, you're going to beat what you would have got in the bank for the same funds. It may not be in multiples, but it will definitely be probably in the score 4 on this category, at least has been in our case. When it comes to capital, there is no growth on capital because it's just you're lending money for returns or interest. When it comes to liquidity, typically it takes a little bit of time for the money to be recovered, be it because there is at least a period that someone has locked in that money. And I don't mean microfinancing or where you're giving money on a daily basis. That would be a very different category altogether when it comes to personal involvement. So it's probably takes around 3 months onwards to 2 years when your money recovery, because the time there is a lock in there. When it comes to risk, this is a high risk category. Our experience says that not only it puts risk on your capital, your returns, but also risks on the relationships sometimes. And that is also when it comes to personal involvement. It may not need a full-time involvement, but it does come with whatever partial involvement you have. It does come with stress, and it stresses the relationships also. So this is about the peer-to-peer lending. The second is a different form of a peer-to-peer lending where you are giving your capital as angel investor and investing in a startup or in a business for expectation of returns, both as income, also in capital growth. Typically, our experience says or shows that there is no short-term returns that you get. You do get long-term returns in terms of profit share, in terms of dividends, but that's when the business starts to make money. So generally, the returns are probably in 3 to 5 years' time. So I would probably put, when it comes to returns, as poor for angel investing. When it comes to capital growth, absolutely. This is the main reason or the objective of investing in some startup or as a company, because you want your funds to grow both in terms of as equity share in the company or the company growing many folds. Generally, the expectation is that you would want 2x, 3x, 4x your funds over a period of time. But because it is over a period of time, probably it's better to put it as 4 rather than 5, because it will get averaged out. When it comes to accessibility or liquidity of those funds, it will be anywhere between 2 to 5 years as a minimum, because when you're giving to a company, those funds are not just lying in the bank, they've deployed it into their business. So the time it takes for them to probably pay you back is also on a mid to long term, as at least 2 to 5 years, I would say probably even 5 years or more. Risk, absolutely. This is a high risk, high reward game. So if there is a 4x, 3x expectation on your capital growth, then you have to also keep in mind that it puts your capital as well as returns at significant risk. Because this is a business that they are getting into. It's an unknown business, maybe as a startup, or you're at least leaving the future of your money in someone else's hands and on the market conditions, whichever industry it's been invested. Personal involvement, it depends. Most of the startups would prefer that you give them that money and they know what to do with that money, and they are doing the day-to-day basis. Personal experience, or our experience, has been that we've always been involved with whatever investments we've done in such startups or businesses, that we've been involved as a hobby and giving them whatever few cents of knowledge that we have. So it depends, but based on our case, I would probably put it as 4. The next one is fixed deposits. So this is where you're giving the money as a loan to the bank. So this is a different kind of a loan, but you're putting it for a period of 1 year, 2 years, 3 years, 5 years as a fixed deposit. When it comes to returns, these are what I would say the market returns benchmark. So this would be in the median form. Right now, with the interest rates being high, the returns on fixed deposits are also relatively high. So this is a good time, or has been a good time, to at least put money on fixed deposits. When it comes to capital growth, there is no capital growth. It's just that you are earning interest on your money. Liquidity, typically, it could be anywhere between 3 months to 2 years, 2 to 5 years, or even 5 years or more, depending on the duration of your deposit. Personally, for us, we've always gone for 1 to 2 years of fixed deposits because it also meets or is part of our bucket strategy, because this is the bucket number one, that this is where the funds that we may use for near to short term. For more on bucket strategy, it's worth watching the video that I made so that you can also use that towards your investment planning. When it comes to risk, typically, if you've given it to a reputed bank, the risk is low both on capital and both on your investment returns. So I would put that this is an excellent choice from a risk perspective. When it comes to personal involvement, there is no personal involvement. This is really your money making money while you're sleeping. The next one is some sort of a side hustle. So as a hobby that you're doing some consulting gig, or you're pursuing your hobby and you're monetizing it, be it photography, be it a YouTube channel, or anything like that. I would give a median rating when it comes to returns, because this is where these are market level returns, and you will have some of your sweat equity, your time that you're investing there, your you're investing in equipment, etc. So this is the median part over there. Typically, side hustles is not where you expect capital growth unless you have really invested in major infrastructure, and even if you have, that's typically will be depreciated, and it otherwise becomes a full-time business for that matter. Same liquidity, I would put it as median, just because if you've invested in any equipment, licenses, etc., it may take time of at least 3 months and above to even cash out from that equipment, whatever has been invested towards that side hustle. Risk, generally, there is very little risk on your capital, but the risk is on your income. And the risk in income is based on the market conditions, where whatever you're pursuing as a hobby may not be fit for purpose, or it could be based on your own time, that you may not have that level of time, so that this income becomes variance rather than a consistent. Unless you've made a product and you're getting some royalties, and those royalties are committed royalties. That's not been in our case. And the last is personal involvement. Generally, you would pursue a side hustle where you are enjoying that, and because it's part of your hobby, and that's at least for us, and you find it gratifying. And therefore I would put it as that even if it is not excellent, because you still have some involvement, but even if there is involvement, you're enjoying that involvement. The next is real estate, that you've invested in real estate, and you've invested for purpose of rentals, monthly or long-term rentals or lease, or even an Airbnb rental kind of model for that matter. So when it comes to returns, our personal experience has been that we've at least got better returns than we would have got in a annual fixed deposit. We would have put that in the bank. But generally, if you net out all the costs, the returns are somewhere which will match what you would have got in the bank. Our experience has been a little better, so I would give it a little better than just the bank, as I said. Capital growth, again, our experience has been that over years, we've always beaten inflation, or our real estate has always beaten inflation. And that's not just us, but I think generally in the market, different countries for the last few years, I would say last quite a few years, the real estate market has been doing fairly well, and it has been beating inflation. Accessibility, as you can imagine, it is not easy to, let's say, sell a property and cash out. It takes even if you plan to list the property in the market and sell it, it takes at least 3 months onwards, sometimes even 1 to 2 years to sell a property and complete the transaction. So we'll put it as at least average or as median. It could be even higher. Our experience has been that within 3 months to 2 years, it is possible to sell a property and liquidate. Risk, generally the risk is on the income, where income, which is your rental, could be at high risk, and high risk because your tenant may decide to leave and it may take time for you to find a new tenant, or your property needs certain renovation so that once the tenant leaves, you may not be able to give it out or let it out for rent, or you may have a COVID-like situation. I hope it doesn't happen again, where the rental market completely freezes because the mobility is frozen during those times. So the rent is definitely at high risk. Capital, generally, again, unless you are only looking for real estate at short term, medium to long term, capital or the real estate properties have generally grown or at least returned back the money that you've invested in. And the last is personal involvement. So yes, managing real estate requires personal involvement. And again, it depends on the different models. One is that you're really personally actively involved in fixing things, dealing with the tenant and their issues. And the other is that you're dealing it passive, where you've outsourced all the dealings of the tenant to a commercial organization or a professional company that manages the tenant. If you do that, then generally your rental yield or return on your investment would be much lower because you will have to pay the company. Our case has been that we've had a mix of both, professional as well as active involvement. So it does, let's say, have its own stress. So I would put it in middle somewhere. The last is dividends. This is when you've invested directly into stocks, mutual funds, ETFs. Generally, the returns as dividends are somewhere in the median when it comes to, let's say, the evaluation criteria. Our experience has been that it's below the market conditions. That is, if you would have put this money as a fixed deposit in a bank, especially right now when the interest rates are high. S&P 500 companies generally give dividends of 2 to 3%. Some companies give higher, and keep in mind the returns are more or less stable, while the interest rates in the banks vary based on the times. And right now their interest rates are higher, so they are higher than the dividends. But there are times when the dividends are higher when the interest rates are extremely low. Having said that, I would put it in category 2 or rating 2, just because our experience has that many tech companies do not give dividends, while some companies give dividends. So if you average out all your investments, the dividends would still return lower than probably the benchmark. When it comes to capital growth, definitely on a mid to long term, your capital will definitely be growing with the company's growth. Yes, there is volatility, that the share prices go up and down, the markets go up and down, but generally on a 3 to 5 years long term, the capital grows. When it comes to accessibility, absolutely. It depends which app, which trading platform you're using. Some you can even trade at fraction of a second, if not fraction of a second, maybe an hour or a day, that you can cash out your investments. When it comes to risk, most of the time the dividends are stable because the companies do not want to scare the markets by changing the dividends dramatically. And similarly, as I mentioned earlier, on a mid to long term, even the capital is stable unless there is a major problem with the company or there is a major disaster in the markets itself. When it comes to personal involvement, there is no personal involvement whatsoever. This is really your money making money while you sleep. So in summary, as you can see from all these 6 investments, my apologies, the best is definitely the dividends. At least it has been for us. And that's why we are big proponents of investing in the equities, in mutual funds, in ETFs, because not only it gives you diversification, it gives you accessibility, it gives you capital growth, and it also gives you passive income. The least favored for us is the P2P lending. Even if you decide to choose P2P lending, our recommendation would be that if there is someone in friends, family, colleagues looking for money, give them as a gift or give them as an interest-free loan. Because the last thing you want to do is not only put money and the returns at risk, but also relationships at risk. And this has been the case for us, and I think it's not the place that you would want to be in. So I hope this framework of this 5 qualification criteria and the 5 rating is very helpful for not just evaluating the 6 passive income streams that I talked about, but any 7th, 8th, 9th passive income streams that you can think about to just go through this stress test that you may want to do. And the good thing of this framework is that you can plot based on your own evaluation where and how you think that these different types of income streams fare. This is our own personal experience. It could be different in your case. And if it is different, do please reach out. It would be great to understand from you based on your experiences. So please do comment on the video. I hope you found the video useful and you found it insightful. And if you did, please do like, share, and subscribe to the channel. Would love to get that kind of feedback from you. So till the next topic, and till the next video, and till the next location, goodbye from me. Bye-bye.